Good morning, students. Hi, everybody. I hope you all had a nice break yesterday for Freedom Day. Okay, is my voice coming through? You guys can hear me? Can you guys hear me? If someone can just say yes or no in the chat. It looks like my microphone's working. Perfect. Thank you, guys. Oh, because I had my headphones plugged out, and sometimes when I plug them back in again, it doesn't connect properly. Okay, so let me just see who we've got online. All right, so just to get our heads back in the game to where we were, we're busy with Learning Unit 5, doing our share valuations. So let's just take a quick look at what our the different sections of the work are that we're doing in this learning unit, and then we can pick up where we are now. Before I go on any further, anyone got any questions? Anything that you want to know or before we carry on? Everybody okay? Okay. Well, you guys just, if you have a question, just type it in the chat box. Oh yeah, there was something I wanted to just check quickly. Where are my dates? Just to remind you, any of you that are wanting to write the replacement test, it's on the 5th of May, which is exactly 1 week from today, next week, Thursday, the 5th of May. So that's just a reminder. So obviously if you've passed, I would say if you've passed, don't bother to write it again. You'll just be wasting time you could be spending on doing all of your assignments and your test twos, etc. So only for those who really need to write it again, who didn't pass the first one, who didn't get 50% or more for the first one, then I would suggest it's beneficial for you guys to write, but don't go and be silly. And if you got 75, go and rewrite it again to see if you can get 76. That's just being silly. Okay, so well, I've lost the date again, the 5th of May. There we go. Okay, so got that reminder out of the way. All right, so our different share valuations that we were looking at and different methods of valuing a share. We, first of all, at the first part of the chapter, we had a look to see exactly what a share is, characteristics of shares, and we looked at ordinary shares and preference shares. And we also looked at the difference between debt versus equity, because remember in LU4, we did bond valuation, and bonds are debt and shares are generally treated as equity unless they are redeemable preference shares, and some other preference shares we treat as debt as well. Okay, so you must know the difference between debt and equity and the difference between ordinary shares and preference shares. Then we had a look at our formulas for the dividend growth models, and we've got two that we use. The first one is if growth is constant. We have got one growth percentage that we use to present value the cash flows from the shares. So remember, that's the one that is exactly the same as the perpetuity formula. And then we've got the variable growth model, where we've got an initial generally higher growth percentage for 5 or 6 years, and then the perpetuity model kicks in after that for what we call the terminal growth period. Then in the last class, we had a look at the free cash flow model, and we went through that whole calculation. So in this valuation model, we said we can use this for a company that doesn't pay dividends, because remember, this dividend growth model, it is the dividend that we're receiving that we are then present valuing to value the share. But if you've got a company that doesn't pay dividends, you've got to come up with another way of valuing the company. and the free cash flow model is one of them, and that's the one where we use our adjusted income statement that we project for 5 years or so, and then we present value the projected amount of free cash that we're going to get. So remember, for the free cash flow model, I said that that formula is not on your formula sheet that you guys will get. Will be given in the test or the exam. So you must use the variable growth formula and just adapt that for your free cash flow valuation model. So also remember, free cash flow, there's calculations that you've got to do there. They can ask you to either calculate the rand value of the free cash, or they can give you the rand values of the free cash flows for a certain number of years and then ask you to work out the valuation of the company using the free cash flows. So make sure you know what the difference is. You know that whole calculation, so that whatever they ask you, you don't get muddled up with what it is they've asked you to do. So today we're going to look at these last couple, which is a PE valuation model, price earnings valuation model. And that is exactly the PE ratio that you guys did last year, market price of the share divided by the EPS, earnings per share. And that just gives us a ratio. So we can use that to value a share as well. And then there's two other ways we can do it, which is a book value and a liquidation value. Those are quite simple. They do definitely come up in tests and exams, all of those different methods. So you must know how to do all of them, because we never know which ones they're going to include in your assessments. So in Learn, they've split it up into two themes. You've got the rights and characteristics of shares, which is those first two learning objectives. And then the 4 learning objectives fall under valuation models, where we've then got them split into the dividend growth, free cash flow, PE valuation, and then book value and liquidation value have been put together. Okay, so that's what we're going to have a look at. What do I want to have a look at? If you look in your textbooks on page 135, that's where we've got in your textbook the price earning, the explanation of the price earnings valuation model, the PE valuation model. Also, just a reminder that you guys don't forget the dividend growth model, both constant growth and variable growth. The answer that we get from those formulas is a per share price. When we use the free cash flow valuation model, that rand value answer that we get is the valuation for the entire company itself, the debt plus the equity. In other words, it's valuing the entire asset value of the company. Okay, remember, and then you've got to do that little calculation at the end if they ask you to convert that value to a per share value. So again, just watch out for that. That's the other tricky bit over there. So in our PE valuation, this method calculates the value of a company by applying a PE ratio. So you know you'll be given a PE ratio. They'll say the company's got a PE ratio of 12 or 8 or whatever it happens to be. To the earnings per share of a company. So this is obviously a very easy model, and if you get this, there's not really too much that has to be calculated, and all it's really based on, if you look over the page on page 136, our regular PE ratio is the PE ratio is equal to price. Sorry, I'm just trying to type with cold hands. Price over earnings. So that price is what we are trying to calculate. Okay, the share valuation, that price, the P, that's what we don't know and what we're trying to calculate. So if we want to solve for P in the price earnings ratio calculation, we are then going to take earnings per share multiplied by the PE ratio. So EPS times the PE ratio will give us the price. So that's what we are then aiming to do. We want to work out what the EPS is. We are going to use an estimated PE ratio for similar companies to the company that we are trying to value. And then we'll adjust that PE ratio up or down for various things like the perceived amount of risk in comparison to the PE ratio that we're using as an example. And then all we have to do is multiply EPS times the ratio that we're using, and that will give us a share price. So it's very simple. So on page 136, they discuss earnings per share, the actual EPS. And on page 136, also underneath that, they discuss the PE ratio, which you did do last year in your learning unit 2 for finance, where we did ratio analysis. So one of the reasons why we use this, why we use the PE ratio or APE ratio to do this is because I don't know if you remember from last year when we discussed the PE ratio. The PE ratio tells us how much shareholders, or not shareholders, how much investors are willing to pay for a share based on the perceived future earnings, i.e. EPS, of that particular share itself. So if a share is in high demand, the PE ratio will be high because the number of multiples of future earnings that investors are willing to pay will be high. So in other words, they'll be willing to pay 5 times the current earnings per share or 20 times the current earnings per share. And that's what that PE ratio indicates. So that's how we arrive at that valuation model. So on page 135 also, they've just got the reminder to tell you that the reason we can use this as a valuation method is because a PE ratio incorporates the future expectations of the earnings of that particular share. Because remember, when you're buying something, a share or a bond, you are buying the future cash flows that that asset is going to provide to you. That's what you're paying for, the future cash flows. If you have a look at example 5.7 on page 137, we've got a company, Pty Limited, has got an EPS of 20 Rand. So take note, they've used there a Pty Limited, which means that that's not a publicly traded company. In other words, it's a company that's not traded on the stock exchange. So we can't look up to see what the market price of the share is because it's not a traded share. So this is why we have to work out what the share valuation is. It's got an earnings per share of 20 Rand. So that we can work out because every company has got an income statement giving us the net profit that's attributable to the shareholders. And even private companies have got shareholders. They are owned by somebody. And those, the total value of the company can be divided into a certain number of shares. So the EPS we can calculate without a share being listed. Now we need a PE ratio. So we go and have a look at the PE ratio of listed companies in a similar industry as where Pty Limited, and we see that they are currently trading at around 5 to 1. So in other words, the price of listed companies is 5 times the current earnings of those companies. So we just then take the PE ratio of listed companies. In this particular one, we're not adjusting that PE ratio for anything. We've said similar companies have got a PE ratio of 5, and we're going to use 5 exactly as it is. And so we then take the EPS of 20, we multiply it by the PE ratio of 5, and we come up with our share valuation of 100 Rand per share. Okay, so you can see that's quite easy. Then the next section in your textbooks, the pitfalls of price earnings valuation model. You must please study that because that has come up in exams before. I see I've got a note here that that was included in the 2020 exam paper. Please don't forget your theory questions and throw those marks away. Then what I want you to do for homework for this section is question 5.3. This question has come up in exams several times before. It was also in the 2020 exam. And this question is really going to test that you understand all of this valuation, share valuation work that we've done so far. Okay. It's got a PE ratio calculation and a dividend growth model calculation to it. You've got the solution for that. Try and do it yourself, remembering everything that I've told you in class about what you've got to look out for and what you might have to calculate. You know, they won't always give you everything you need for the formula. You might have to calculate some things. So that question 5.3 is a very good example of doing that. I just want to show you, just a second, let me just go back here. I'm going to share my screen for a second and just show you where you can find some other information on that. So if you guys go to learn, so this is your LU5 theme 2 valuation models in learn. If you go to this first page, you'll see there are all of these little blue highlighted amounts. You can click on all of those and it will take you through to a screen where there's a discussion and another explanation. There's some videos on some of those pages, and that will help you to revise and to get an understanding of all of these different concepts that we are doing. Okay. Let me just find, that was book valuation, liquidation. Okay. So I'm not going to go through this here. There's a P. What is the PE ratio? There's a short video here. You can watch that again just to remind yourself about PE ratio. And you do have to understand what a PE ratio is in order to be able to understand why we can use it as a valuation method. Okay. So the next two valuation methods that we've got to do, they're very quick, very short, and very easy. Again, as long as you know the rules to apply, you won't battle with them. And that is the book value and the liquidation value method. Okay, the last two, book value and liquidation value method, page 138 and 139 in your textbooks. So what is a book value definition? Let's go and have a look at that. When we talk about book value, that is equal to the cost of carrying an asset on a company's balance sheet. So for book value, you literally go to the company's books, which is your statement of financial position, your balance sheet, that lists the value, the current carrying value of all of your assets, liabilities, etc. Book value is also called net asset value, NAV. I don't know if you've seen that before, which means my total value on my statement of financial position of all of my assets minus liabilities, because we know liabilities is that part of the asset value that I owe to outside people, to third parties. What's left over is then the net asset value, and that's the part of the asset value that belongs to the equity owners, the shareholders, the owners of the company, and the equity owners are the people who own the shares. Okay, and then all we do is we take that net asset value and we divide it by the number of shares, and we get a price per share. Okay, so let's just have a quick look at that. What you've got in your textbook is very similar, and you've got an example 5.8 to go through, so you'll be able to easily understand that. So it calculates the net asset value against its accumulated depreciation. So that, again, carrying value of the asset, which means net of depreciation. So book value is then the net asset value of a company, calculated by taking its total assets minus, and don't worry about this intangible assets thing that they've got here on this particular screen. If you get a question, they will tell you whether you need to include intangible assets or not. Sometimes with book value we do, and sometimes we don't. It depends entirely on the exercise that you're doing. So total asset value, and then we get the net asset value divided by the number of common shares of the company, and we then calculate the share valuation. So the book value of the company is the net difference between that company's total assets and minus the total liabilities. So the book value reflects the total value of a company's assets that the shareholders of that company would receive if the company were to be liquidated. So we take an asset's book value as being equal to its carrying value on the balance sheet. So that's easy enough. You don't have to make any adjustments, just the carrying value. You just have to be able to identify those assets correctly minus the liabilities, just to do your calculations correctly. So that is quite simple, and there is a little video here that you can also play to understand book value. And if you look at example 5.8, you'll see how simple it is. There you've got a little statement of financial position. We've got total asset value of 5 million. We've got total liability value of 2.5 million. There is share of R2.50 per share, which gives us 250,000 rands worth of capital. And then there's also goodwill of 500,000. So in this particular example, the value of the company using the book value method is 2 million. In other words, you've taken the total assets of 5 million minus the total liabilities of the 2.5 million and the goodwill of 500,000. That then gives us a value of 20 Rand per share, which is the net asset value of 2 million divided by 100,000 shares. And how did we get that value, the number of 100,000 shares? How did we come up with that value of 100,000 shares in this example? Remember, I said in examples and questions, they often get you to, they don't say there are 100,000 shares in this company. They will give you information and then you have to calculate it. How did they calculate the 100,000? Yeah. Okay, did the rest of you pick that up when we were going through the question? 250,000 Rand is the book value of the capital, and they've told you that that represents shares valued at R2.50 each. So if you divide the 250,000 Rand capital by R2.50 per share, it will give you the fact that we've got 100,000 shares. So you can't calculate the share valuation per one share if you can't calculate how many shares there are. So don't get stumped by that. Okay. So that one is fairly simple. Then we've also got the liquidation value. So you'll see now why we look at these two together, because they are quite similar. So for the liquidation value, we are also going to go and have a look at the statement of financial position, which lists all of our assets and liabilities. But instead of taking them at their face value, i.e. book value, exactly as per their carrying value, we are going to adjust the value of all of our assets and all of our liabilities based on what we think their liquidation value is. So what do you think liquidation means? If I'm going to liquidate all of my assets and liabilities, what am I going to do? Yes, we're going to actually sell them off. So we're actually going to go through the balance sheet, and we are going to, for each of the assets and each of the liabilities, could I raise if I sold each of the assets? In other words, it's real price that I would really get today if I sold it. And if I settled each one of my liabilities today, how much would I be able to negotiate as a settlement value for each of the liabilities? And that the difference then, the assets, liquidation value of the assets minus the liquidation value of the liabilities, is then the net value of the company. And again, that net value we divide by the number of shares and then get a value per one share. So if you think about it, book value, liquidation value should be essentially more realistic in terms of a value than book value. Because we know book value we're doing according to IFRS rules, and the IFRS rules are set up to make sure that our carrying value of our assets and liabilities are as accurate as possible all of the time. But sometimes with assets that we're using the cost model, we might have depreciated an asset right down to almost nothing, but we might be able to actually get something for that asset if we sold it. Or we might have an asset that's got a fairly high carrying value that when it came to actually selling that asset off, we might not be able to sell it for the value that we're carrying it on our books at the moment. So kind of like working out the fair value of all of your assets and liabilities all in one shot at once, instead of every now and again as we do according to the IFRS rules. So the liquidation value is the net value of a company's physical assets. So net value means the value of the assets minus the liabilities that we have to pay for if it were to go out of business and all of the assets were sold. So the liquidation value is the value of the company's real estate, land and buildings, fixtures, equipment, inventory, etc. And in this particular valuation, we exclude intangible assets. There might be some examples. I mean, if you've got an intangible asset that you can sell, it's perfectly saleable, that would be included. But again, intangible assets are always a gray area. But if you were ever to get a question, they would tell you exactly what to do with intangible assets. So again, just in summary, the liquidation value is the total worth of a company's physical assets if it were to go out of business and the assets were sold. And the liquidation value is determined by a company's assets such as what we'll call in the physical assets, land, buildings, fixtures, fittings, equipment, inventory, etc. We exclude intangible assets, and usually liquidation value is usually lower than book value. That's just the way things go. Usually when it comes to actually selling a company's assets, we can seldom realize the full book value of those assets. But greater than salvage value. Salvage value is if you had to sell goods off in like an emergency sale and you just got scrap value for them. Assets are sold at a loss during liquidation, and when we say they sold at a loss, we mean at a loss to book value, because the seller has to gather as much cash as possible within a short period. So that means we have to take whatever we are offered for the assets when we sell them, because we're going into liquidation and we have to sell them quickly, and we've got to sell everything at once. This next paragraph here, you guys can read through just for some extra information for yourselves. It's just as long as you understand this basic takeaway at the top over here, because that's the real. Oh, that was the slide I was looking for just now. Couldn't find it. So this one over here is quite helpful. Valuation formulas, and this is in one place where they say book value and liquidation value, and you look at the two together. So again, I quite like this explanation of book value because they also talk about adjusted book values. And then here again, there's a short explanation of liquidation value just in a paragraph as well. That's very easy to understand. So this is also a very good explanation. And where I got to these pages is straight from these. Just go and click on these blue highlighted book value, liquidation value. It will open those internet pages for you to read. This other one over here is also quite a good explanation. Business valuations using price earnings ratios. So this again is an explanation of what we looked at just now with the PE ratios. Again, but quite like the way that this was written up. It's easy to understand. So go and have a look at that page as well. Okay, so if we go and have a look at example 5.4, which is then your liquidation value example. So you can see how it works. So this is similar to what we've given if you had a question on this in the exam. They would have to give you the balance sheet of a company. So here we've been provided this financial position for the year ended 31 December 03. So this company has got non-current assets, PPE, and then they've got other current assets, cash and cash equivalents, financial assets. So financial assets would be maybe like shares that they own, shares or bonds that they own in other companies. Trade receivables, that's their debtors, people who owe them money, and inventory. So those are our current assets. That's total asset book value of 966,000. Then in equity, we've got ordinary shares with 414,000 and reserves worth 92,000. So reserves are not quite the same thing as retained earnings, but it is kind of, it's profits that we've earned in the past that we reserve in usually for something specific. So that's the equity. Book value of the equity, 506,000. And then the book value of our liabilities, we've got bank loans of 207,000. Then our trade payables, those are our suppliers, we owe 138,000 to. And then other sundry payables, we owe other people 115,000 to. That could be our landlord, the municipality, who knows, but other. So we've got total liabilities of 460,000, money that we owe. And again, that's the book value of the liabilities. So again, our total, at the moment, our total assets and our total equity and liabilities together both add up to 966,000. Now we are going to have to assess, that's the book value. Now we want to say, okay, so what's the liquidation value of these assets and liabilities? So the additional information will tell us that included in that PPE of 460,000, there's land and buildings of 172,500. In other words, that's their carrying value, and plant and machinery with a carrying value of 287,500. This company has got 12,500 ordinary shares in issue, so that's number of shares in issue. All interest and dividends are currently fully paid up, so that just means there's no liability that the company owes at the moment for interest or dividends to the shareholders. Then we have got a professional valuer to come in and go through actually go and physically examine our assets and give us their view of the liquidation value. Provided us with the following liquidation percentages. So they can also give us the liquidation value as a percentage of the book value, or they can give it to us as a rand value. So our trade receivables, they'll say we are likely to get realized 95% of the carrying value. Inventories, we're only likely to realize 70% of the carrying value. Land and buildings, we could actually sell them for 20% more than the book value at the moment. Plant and machinery, only 80% of the book value. And then cash and financial assets at book value. Usually that's 100% accurate cash. And bonds and shares, there's no negotiating on those values. The price, the listed price, which would be your book value, is the price that you would get. So then using the information provided, calculate the value per share of the company using the following bases. So the first one then is the book value, and the second is using liquidation value. So book value, we know it would then be the actual carrying value assets minus the carrying value of the liabilities, and the difference is net asset value divided by our 12,500 shares in issue. And then to calculate the liquidation value, you would first have to rewrite out your statement of financial position with the new values for each of your assets and liabilities calculated, and then take assets minus liabilities and divide that net asset value by the 12,500 shares in issue. So that question 5.4 also is an absolute must. You must work through that question to understand both values. You can easily get that question in, is our share, yeah, share valuations. This is our last chapter for test 2. So usually a long question like that would come up in the exams where you get, they can give us a question like this and ask for both valuations. That would be a very good exam question. And it has definitely come up before. Okay, in a test, they'll probably ask for either book value or liquidation value because we've only got 60 marks, but you need to know all the methods because we don't know exactly what they will ask us for. Okay, so that's all that we've got to cover today. But now for your homework, remember you guys are going to do question 5.3. And you're going to have a look at the examples that we've done today for the PE and book and liquidation. Then you must make sure that you can do your question 5.4 without looking at the answer. That's the one that we've just had a look at now. And then very important, the revision questions at the end of every chapter. These are perfect test and exam questions, and particularly revision question 2. Make sure that you can do this one. Use that one to practice. That's one where you've got to cut the question 2 on page 142. You've got to calculate. You've got to calculate the growth percentage, etc., etc. It's really a good question, something that you should be able to do. Question 5, revision question 5 has also come up in exams before, using the free cash flow valuation model. And all 3 parts of question 5 have come up, so don't just calculate part 1, calculate the value. You must also be able to calculate the value of their equity, because remember we said with free cash flow, you're calculating the total asset value of the company, and we only want to know what the equity is worth, and then suggest an initial list price per share. So that one you must definitely be able to do. Let me just take a quick look at what was this one. Yeah, your question 4 is also quite a good one. Revision question 4. Definitely 5. Question 6, they want us to, yep, question 6, dividend growth, price, earnings, and free cash flow. And then also question 7. So your revision questions at the back are very important. Okay, make sure you can do all of those. Okay, guys, so I'm going to leave you now to go on and read through all of this. Make sure that you've got Learning Unit 5 understood, most importantly. If there's anything that you don't understand, make sure to ask me, that you've understood everything, and then that you've practiced all of those examples and the questions so that you're happy that you are able to do those without looking at the answers. And then when we've got class again next week, which will be on campus on the 3rd of May, then we're going to start our first exam chapter, Learning Unit 6, Capital Budgeting Applications. So we've only got 2 learning units left till the exams. They are, it sounds like a little, but they are quite long learning units with quite a lot of work in them. But yeah, you guys are nearly there. So remember, for your test 2 is learning unit 3, 4, and 5. And our test 2 is also, it's coming up very shortly. Let me just quickly get the date here. Test. Finance is going to be on the 17th of May. So we basically really only have 2 weeks, and if you count this weekend, so 2.5 weeks time. And you've got 3 learning units to cover in 2.5 weeks, and that's 3 learning units with quite a dense amount of work in them. So you've basically got 3/4 of a week per learning unit for your revision for test 2. It's a lot to cover, so please make sure that you start immediately on that revision for test 2. Okay, and yeah, so you can see by trying to write test 1 all over again, you're going to be shooting yourselves in the foot. So I highly do not recommend it. If you've passed test 1, put it behind you and you go on now and you work super hard for test 2. Okay, guys, I'm going to stop the recording.